What's up, everybody? Welcome to the October 20th, 2025 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by IndiWealth. Today, we're going to get right into the hot button topics because there's a couple interesting ones out there. So let's get right into it. Let's start with here. Last week, we had a little bit of a bank scare. There were some indications that a couple of large bankruptcies were going to lead to excessively large losses at a couple of large banks, which sent the regional banks into a bit of a mini tailspin with regard to performance for the week. I'm not reading a ton into this one yet. So I think the biggest commentary and the thing that spooked investors the most was Jamie Dimon's comments, which often are highly publicized, but often under the lens of he tends to be a little bombastic. And his commentary was that usually there's more than just a few cockroaches out there. When you see one, it's not the only one, something like that. He's right, is that a lot of times these things can lead to greater things that we didn't see at the outset. And so these initial bankruptcies, these initial losses can cascade into other things. And that's why you saw the regional bank sell-off. I'm not there yet on this one. We'll see. I don't see this as a redo of Silicon Valley Bank and those other things where we had a real true bank scare. I'm not there yet on this, but it is something I'm watching. But I think the bigger thing for me, and I've heard this from a couple of different places that I've read on this over the weekend and this morning, is the potential implication of what we call shadow lending or shadow banking, which is other institutions, non-traditional banks, right? Not where you go to a branch and you get a loan. These are other institutions that have been acting as pseudo lenders in place of, or sometimes in complete substitution for, a regional bank conventional type of loan. And there's estimates on the extent of the size here. There's estimates on the amount of regulation, which is a little less. There's a lot of estimates that show that this avenue, the shadow component of banking, has been growing over the past few years. And the worry for people is that because that is much bigger and because we know less about it, because they're not subject to the same level of regulatory scrutiny as the traditional banks, there may be a bigger problem hiding in the shadows here. Again, I'm not there yet, but it is something to pay attention to, and just understanding that there are multiple avenues of lending for companies, for individuals, and these kinds of things. And it might not all be under the balance sheet of the traditional banks. And so a lending problem may be outside of traditional banks at this point right now. But we really don't have enough information to say that for certain as of yet. But it is something we're going to watch and pay attention to and see if there's any data that comes out that shows that this is a worsening problem. Number two, read this from Goldman Sachs this morning, is that companies with negative earnings post the April decline. So from April till now, companies with negative earnings have actually been outperforming those with positive earnings, which is interesting. I call it lower quality is outperforming right now. This tends to happen from time to time. It also tends to happen when we're in the stage of a little bit more speculative nature. I would call this market a little bit more speculative than it has been in the past, just given where we are from a valuation perspective, given that asset class performance in almost all asset classes is pretty darn positive this year. And then secondarily, when you start to see this kind of stuff, you also start to see it when you go from a Federal Reserve that has had tightening policy to loosening that up and becoming less restrictive. So sometimes that helps these lower quality companies over a longer period of time because they have to lend money because they don't have earnings coming through. They have to lend money to sustain and grow their businesses. So if the Fed is being supportive, their cost of capital can tend to be a little lower. I think it's a little bit of blend of both. To be completely honest with you, here at IndiWealth, we tend to only invest in companies that have positive earnings. There's occasionally, some tech companies we'll invest in from time to time if they have negative earnings profiles but high cash flow. But we tend to focus much more on recurring revenue type of models, a little later stage, to be completely honest with you, proven but still growing, these kinds of things. But we really strive for financial health in the companies and the individual companies when we choose to invest in individual stocks here. That's one of the focuses that we pay attention to. So during times of lower quality, negative earnings companies outperforming, we fully understand that we're probably not going to participate fully in that because we don't invest in those kinds of companies. And we have to be okay with that as being a source of a headwind when these kind of companies are outperforming. Third, we have a big week of earnings coming up. We have a broader swath, so we'll get a little bit more of a sense. This last week was much more financials focused, which again, I've said this a few times on here, but I think that's great. I think we do start with financials because financials give a good picture of what's going on with everybody. You know, what's happening with loan growth, what's happening with credit cards, what's happening with their balance sheet profiles. Are they tightening? Are they restricting? Are they increasing? Are they loosening? Those kinds of things. You get to know a lot by financials in that first week. And I would say just a quick recap on that is financials companies reports in general were pretty strong. I didn't sense a terrible amount of weakness in there. Even going through them a little bit more, they sense that the economy is still holding on okay. There is a dichotomy. There's a little bit of a separation here between the haves and the have-nots. The have-nots are struggling a little bit more than the people who have assets, who have participated in the rally that we've seen, have probably decent to higher paying jobs already. They're still doing the exact things that they've been doing before, spending money, traveling, doing the kind of stuff that they do. Among the lower pool where there's less assets that have, expanded rapidly in this environment, inflation is a bigger hit for them. There's a little bit more of concern there. Auto delinquencies, auto loan rate delinquencies have risen aggressively. Credit card usage is rising, those kinds of things. So in that medium to lower end cohort, there's a little bit more of a struggle there. I think that's probably the biggest difference I saw in when I looked at financial reports is they were estimating some caution among the mid to lower tier income households, while the mid to upper tier households were still spending aggressively. But this week we'll get companies like Netflix, GE, Coke, Raytheon is RTX, Tesla, UNP, which is Union Pacific, which is a railroad, and Procter and Gamble. So again, a little bit broader swath, a lot of industrial focus. So we'll get to see a little bit about what's going on with tariffs and imports, exports, those kinds of things. How are they passing through the costs, especially somebody like a GE and a Coke and a Raytheon and a Procter and Gamble, which get inputs from everywhere and sell it to the consumer or sell it to their end markets. So we'll get a little bit more goods analysis at this point right now and seeing how tariffs are impacting that and how just the general economy is accepting potentially higher prices due to those tariffs. Also, Netflix and Tesla, they tend to be kind of independent animals. I don't use them as real aggressive indicators of an overall economy. Netflix subscriber growth and growth of their components in their business. Again, it just independent of a general economy. I guess if they were saying, hey, subscribers are falling off a cliff, people are canceling, that might be a sense of consumer sentiment is getting a little worried, but not a great indicator. And again, Tesla, from Tesla's side, you used to be able to use it as a barometer, a little bit of overall auto growth, but even then, the EV has, EV as a percentage of overall and Tesla as a percent of overall EV is much more difficult to make a broader swath and a broader commentary on what's going on. So if you own Netflix and Tesla, you pay a lot of attention to what's going on in their earnings, but if you're using them as a barometer for the economy, they're not that great. Lastly, and on a personal side, I have a hot take here. I used to argue with this with one of my colleagues from my prior place of business, is that I believe 50s and 60s for high temperatures. Now, you people on the West Coast and in southern climates are probably going to think I'm a lunatic, but 50s and 60s I think are great. I think that is my jam with regard to things I can do outside, going out, fall components, seeing the fall colors, that kind of stuff. There's a component to that, but it's also just the weather. I think 50s and 60s where you can wear, potentially a light jacket in the morning and then maybe take off that jacket and have just a long sleeve and some jeans on or something. Or, my favorite weather is literally jacket in the morning and evening and shorts and a t-shirt during the middle of the day. if I could find a place like that that's like that year round, I will be a happy camper. But 50s and 60s, I was out this weekend a ton and just was never really sweating that much. I just really like this temperature. Again, I know people, and my colleague would vehemently disagree with me back in the day. He liked 70s, 80s. He thought 70s were kind of on the cooler side. He was an 80s, 90s guy, and I'm just miserable. Anytime it hits 90 and above, I'm not a camper for that one. So I live in Minnesota. There's a reason why I live in Minnesota. Outside of August, July and August, we don't really get much for 90s. And then even then, it cools off pretty aggressively. So I think I'm in the right climate for me. I would like a little bit more temperate. I'd like to be in 50, 60s all year round. I certainly don't like minus 50 and minus 60, which is sometimes what we get here. But overall, I think we're in my ideal conditions for weather right now. So that's it for me for this week. Tune in next week where we'll have our next hot button topics. Until then, take care and thank you very much.